Welcome back. You're watching Bana Salna right here on ET Now. But the one big newsmaker yesterday and this morning has been the RBI, naturally, with that surprise 25 basis points rate hike, the first one in nearly 4.5 years. We have seen the bond markets react sharply to that. In fact, it's more at a level of more than 7.9%. And more importantly, the stance as well has been changed from hawkish to neutral. So let's understand the impact of this rate hike on the economy, on the markets, with Shanti Ekambaram of Kotak Mahindra Bank. Shanti, good morning. It's always a pleasure chatting with you. Let's start off first with your initial assessment. You know, many say that with this rate hike, the RBI has managed to stay ahead of the curve, though of course we did have a couple of banks already preempting this move perhaps and hiking rates. But yeah, your initial assessment on this rate hike by the RBI.
So I think, if you go back to the previous policy, while there was a little bit of a dovish stand, RBI had clearly laid out what were the risks or upside risks to inflation. And I think one of the key upside risks that has really played out has been the crude prices. India basket has gone from $66 to $74, and that's clearly impacted inflation. As you can see, inflation has gone up. So I think the policy, the rate hike, in fact, most of the market participants expected a 25 basis point rate hike because you could clearly see the trend of inflation uptrending. So I think the first thing is that the central bank went by data, and the data showed that thanks to one of the risks, which is crude playing out, the rate hike was necessitated because it caused a lot of other volatility. Second, you saw the global markets as well, both growth as well as yields hardening. So I think, having said that, I think you must take away some of the positives that have really arisen from this whole highlighted in the policy. Firstly, you've seen growth coming back. You saw Q4 at 7.7% GDP growth, which is probably one of the highest that we had seen for several quarters. So yeah, we may have seen a rate hike after 4.5 years, but we've also seen a growth of 7.7% after some time. And that has been led by private consumption, strong rural demand, government spending. There is two-wheelers, there is four-wheelers, there is commercial vehicles, construction, cement output, steel consumption. So if you look across the spectrum, you are seeing also growth coming back. So I think clearly inflation expectation is higher, but growth expectation is also coming back. And the way we look at it from a financial sector perspective is, thanks to the liquidity tightness, you had seen banks already transmit increase in deposit rates as well as in lending rates. You've seen the banks increase deposit rates for the last, if you look at 60 days in perspective, starting right from March. And if you look at it, MCLR of several banks and non-banks, let's take somebody like HDFC, has also increased anywhere from 10 basis points to 20 basis points. So I think the market probably, as practitioners, pretty much priced in the tightness of money, liquidity and rates, and has reflected that. So I'd say yes, a rate hike has been done, but there have been many positives that have come out, which really on the growth side, and you've got to look at it in balance.
Shanti, hi there. Good morning. Just wanted to understand what you think will be the future course of action from the Reserve Bank now. Do you think that this is the start of a deep rate hiking cycle, or that we could see a prolonged pause by the Reserve Bank now?
So I think the central bank will go by data, and I think there are 3 or 4 or maybe even more, but key variables, both global and local. First of all, price of oil remains central. So price of oil comes off sharply, then you can say perhaps inflation will be a little more subdued and maybe there could be some kind of a pause. Second really is you're looking at the factors relating to the fiscal deficit. I think one of the things that, or 2-3 factors that you see. First, what is going to happen on the minimum support price? How will minimum support price get executed? Second, you have seen increase in fuel prices only in the last 30 days or so. How will that transmit out into the market? Third, the state governments have yet to play out their HRA, under the 7 CPC, the increase in wages. You've seen input costs go up for the manufacturing sector, you've seen wage costs go up, you've seen minimum wage costs. All this is inflationary. So let's come back to what the central bank has always said. We would like to target inflation around 4% plus or minus. So I think all the factors that I talked about right now are inflationary. And RBI has already raised the inflation expectations by about 30 to 40 bips next year versus the February policy. You also saw the household inflation expectation 1 year hence going up by 130 basis points. So my own sense is, if you put all these factors together, unless there is a sharp come off in crude, I expect inflation to be on a slightly higher trajectory, which possibly means you can expect another 25 basis points rate hike at least in this calendar year, as I would say. We will wait for data to see the financial year. Unless all these factors are subdued, you would probably see inflation on a higher trajectory, and possible action maybe, depending upon the data. So I think the global factors are also not to be, sort of ignored. If you see global growth and global yields, if yields continue to harden, if central banks continue to sort of, run off some of the expansionary measures that they have, and thus liquidity tightens to emerging markets, that will also act as a tightening factor, which will come through currency for us, and thus you could see again inflationary pressures. So I think inflation will be the fulcrum, but many global and local factors will affect it. But my own expectation is perhaps another 25 basis points during the calendar year. Now you have August, you have October, you possibly have December. We'll have to wait and see how data plays out.
Shanti, you spoke a lot about inflation. Interestingly, the RBI had a comment on the same. They're seeing an important compositional shift in the CPI. You mentioned, of course, on how oil as well will shape up going forward. So when they say compositional shift, what exactly is the RBI talking about? Is it about the weightage in crude perhaps and how it's changing on the CPI?
I'm not so sure whether the weightage of crude has shifted, or I haven't at least got into depth of what composition means. But I think when you look at it, it is about consumption inflation, it is about food, it's about fuel, it is non-food and fuel inflation, which is really inputs and wages that have gone sharply. One of the reasons for this hike, apart from crude, also has been the sharp uptick in the non-food and fuel inflation. In fact, in this period, perhaps it's been a little more subdued, fuel and food. So I think, I don't think that there has been a major shift. I think it is about inputs, food, fuel, crude, fisc. I think all of these factors will play a role in inflation as we look forward.
All right. What about bond markets then? What exactly is your own expectation on how the bond markets would do? We already did see that knee-jerk reaction come by. There was an up move. In fact, the 10-year yield is at about 7.9-ish around. How do you see the bond markets move at this point of time? And is there any change in your own GDP projections for FY19 first half, second half?
Firstly, on the bond markets, I think bond markets have been on a rise if you look at the last 3 months or 4 months, etc. I think post the February policy, it ran away with itself, which was also levels that was, unusual. And thereafter, there has been a steady climb in the bond yields, both in reaction to global markets as well as local market factors, which is tightening of liquidity, money flow, currency, etc. I actually see that if the inflation numbers play out like I have been talking about due to these various factors, bond markets are likely to be in tight and higher yields. I think it will go with sync with factors that I have talked about which affect inflation, as well as the global yields and fund flow. I think liquidity is also a measure. If you look at the last 3 months, liquidity has been one of the reasons why bond market yields have increased. Now with inflation targeting and the fiscal deficit worries that people have, bond yields are likely to remain elevated and on a higher trajectory from here on, unless some of these factors changes.
Right, Shanti, lovely having you with us on the show. Thanks very much for giving us your expert
projections.
Right. Thanks for giving us your expert opinion on the RBI policy as well as the future course of action.